For our last panel for today, From Startup to Exit, welcome our panelists Tony Bielawski, Andrew McWilliams, Kirk, Manz, Rod Laughlin, and Eli Rubin.
Good afternoon. My name is Tony Bielawski. I have 35 years of healthcare experience. I was recently retiring from Ernst & Young, where I was the leader of the Southeast Region healthcare practice. And during my time with EY, I worked with many companies and organizations, including startups, and with many private equity portfolio investees, including one that was founded and formed and eventually became the company you all may know as Acadia Healthcare, located in Nashville, Tennessee. So with that, I'll let Andrew introduce himself.
I'm Andrew McWilliams. I have about 25 years of healthcare experience. The last 10 years or so have been dedicated to behavioral health. Most recently, I was the CFO and then CEO of American Addiction Centers, which was focused on substance abuse. Prior to that, I worked at Ernst & Young, worked on a whole variety of different types of transactions in the space, similar to Tony, startup, kind of to exit in all stages of different sectors of healthcare. And then now I'm serving on a couple of boards for behavioral health and advising private equities on, in terms of diligence, acquisition targets, and working on growth phases of various behavioral healthcare companies.
I'm Rod Laughlin. Feel like I've been in healthcare all my life. Right now I'm CEO of a company, Perimeter Healthcare. We have 10 facilities around the country, either acute psych or a couple of PRTFs, serving principally child and adolescent patients. We also have some adult and geriatric services, and have grown rapidly over the last 5 years or so, delayed only by the pandemic and difficulty of hiring staff now. I started several other companies in the past. Regency Hospital Company, which was 19 facilities with 3 or 4 under development when it was sold to another party in our business. I started a company called Transitional Hospitals Corporation a number of years ago that also had about 20 facilities when it was sold to a competitor. And I spent a little bit of time at Charter Medical in my formative years, really learning this business and learning how to grow a company. And that is the thing that I enjoy the most, is attracting a management team, building up the talent, building up the number of facilities, really working on the quality of the program, and seeing something really come together and gel in the way you've planned it from the start. And so I love the strategy portion of healthcare as much as the operational side.
My name is Kirk Manz, and I'm the CEO of Athena Care, and we are an outpatient mental health provider currently in the state of Tennessee with 7 clinics there. Got started in the behavioral healthcare space in 2007, where I raised capital for a company called Foundations Recovery Network, and then became an operator in the addiction treatment space in 2010 and joined the early American Addiction Centers team there, and as CFO helped grow them to what ultimately became 1,300 beds when I left at the end of 2017. And during my time there, I had the good fortune of working with Mr. McWilliams, and very passionate about the behavioral healthcare space, and excited to talk to you all today.
My name is Eli Rubin. I'm the founder of Proud Moments ABA. We're a national ABA platform that services 15 states with 45 office locations. I started my career actually in the revenue cycle management space, and understood some of the headwinds that provider reimbursements dealt with on a day-to-day basis. Sort of saw an opportunity in ABA on the heels of the ABA mandate, so I started that business in 2014. and grew it into about 5 states, 15 locations. And then was fortunate to partner with a sponsor in Q1 of 2019, and have since done about 8 acquisitions with the company. And that's our story.
So the first question is going to focus on startup, and I'm going to direct it to Rod first, and then the other panel members can comment. And the question is, what are some of the key challenges, considerations during the startup phase from your experience on capital formation, identifying targets for acquisitions, or starting from scratch? And then finally, in hindsight, what you know today, what would you do differently, if anything?
All the companies I've started in the classical business school methodology. And that is to first plan, and that came not only from my education, but from my experience in the real world in the first couple of hospitals I joined, the first couple of hospital companies, where there was no strategy. They had a pot of money. They seemed to buy anything that was for sale. And they wound up with a hodgepodge that made no strategic sense whatsoever. And generally, when you find a lack of strategy like that, you also find a lack of operating performance. So I've tried to really think about the strategy for a company and modeling that company on paper before I do the first thing. And typically, you think about your source of capital. Most of the projects I've done have been backed by private equity, occasionally by another corporation in healthcare. But it's important to be able to enunciate to an investor exactly what you're going to do, how it's going to work, how you're going to be paid, how fast the cash flows are going to build up, sources and uses of funds. Here's how much capital we need, here's how many projects we can do, here's when we get to break even, and have something that's predictable. And so if you're off track, you at least understand why. I think in terms of strategy, to identify the services and the setting we want to provide those services in. And then I think about the source of capital. How much money do I have available? What's the time frame of that money? When does somebody want a return on it? When do they want to divest? And so it gives me a sense of what kind of window of opportunity I've got to build something. How much of a hurry am I in? Because then that drives decisions like, do I acquire? Do I build de novo projects? Do I buy or lease? And just practical decisions that you have to make before you really seriously start risking capital in an endeavor. And then I want to have a projection model of that to show what I think the typical project is going to cost, how many of those can I do, what does my corporate overhead need to look like during that phase. One of the challenges in the startup phase, particularly if you're backed by private equity, who usually wants to get to break even very, very quickly. They don't want to have any more startup losses than absolutely necessary. There's that tension between the number of staff you can afford to have, the salaries you can afford to pay, while you're trying to get hospitals profitable. And it's one thing to get a hospital project profitable. It's another thing to get the whole company profitable. So you've got to keep your eye on cash flow during that process as well. And so I would say the biggest challenge that I've found is having enough and a high enough caliber of employee during that startup phase that you can get the job done in a first-class fashion and come out with something at the end of the day that is like the strategy you went into it with. I think it's important to think about all these considerations really when you start, so that when you come to the exit stage, you've got a product that looks like something someone else would want to buy. If it's a hodgepodge of things that are hitting on some cylinders some days and not always, that's much harder to market and sell than something where you've got a pure play or you've got a couple of legs on the stool that are aligned and so forth. So just some considerations that I always think about when I'm starting something.
Okay, then we'll move to another question, and this one will be on growth. And the question will be directed first to Kirk. And the question is, what are the build versus buy considerations on expansion into new markets, including considerations about raising capital, whether it's internal or external?
So the conventional wisdom is if you build something, it's going to take less capital, but take you more time. And if you buy something, obviously, you have the opportunity to get to scale faster, and you have a general sense, ideally, in terms of what it is that you're buying, but it's going to cost more capital. And so as someone looks to kind of go through that next stage of growth for a company, really getting a good sense in terms of which of those components are most important. Is it speed? Is it you want to grow the business organically and maintain control? Are there capital considerations that need to be really thoughtfully digested and determine which direction on that path that you want to go? At American Addiction Centers, which was an inpatient addiction treatment facility that we grew across the country, it was about 50% build and 50% buy over the years. And I would say the de novo projects that we did were all winners. I don't know that all of the acquisitions that we did were all winners, but the de novo projects took a lot of time. That was a very capital-intensive business, and we owned the real estate. And so these projects could take as many as 2 years or more from the time you decide, I'm going to go into this particular market, we're going to build a facility here, finding that facility, outfitting it, opening it, getting it licensed, getting it staffed, and then getting to maturity. And those were very capital-intensive projects. Versus we look to enter into a new market or state, and we say, here's a potential operator that's there, that we have the benefit of buying that and getting into that market faster, and then trying to leverage by doing additional organic growth within that space that may be adding more beds at that facility or opening up other clinics or offering other services there. At my current company, Athena Care, which is mental health outpatient, compared to residential addiction treatment, the capital is much less intensive. And we don't own the real estate. And on the one hand, it's faster to go into a particular new market. And so when we look at to build or buy, we have a good sense in terms of how long it takes for us to open up a new clinic and what's the capital going to cost and how long is it going to take us to kind of get to a mature phase. And we compare that against buying something that's in that particular market to help us get there. And our challenge in the mental health outpatient space is that there's just not a lot of supply of quality assets for us to look at, to buy, to go into a particular marketplace. And as a result, we've been more focused on building centers. What we would look at is, for instance, if we were going into a new market and there was a smaller provider that had good rates and established reputation that we can then acquire and then add services to it and then organically grow throughout that particular marketplace, then that's something that becomes very attractive to us. Regarding the capital side, at American Addiction Centers, when we started the company, we specifically took a path that did not focus on raising capital from private equity investors. And so we grew that business through real estate partnerships and friends and family capital and bank debt and mezzanine financing until we ultimately took it public in 2014. And the benefit there is that we, the management and the board, maintained control of the business and the majority of the ownership. And when we went public, we had 90% of the ownership was held by the management team and the board of directors. And typically, if you have a capital-heavy type of a business plan and you're looking to outside institutional capital, then again, your concerns are going to be aspects related to control. So if you bring in an institutional investor, how much of the company are you giving up to access their capital? And ultimately, an exit timeline. And what's their fund's exit timeline, and how does that mesh with your long-term strategic goals in terms of what it is that you're trying to accomplish? So there's not necessarily a right or a wrong answer in terms of build versus buy. It really is dependent upon your specific business plan, the M&A market environment, what multiples are being paid at that particular time, who your capital partners are, and what their timing horizons might be that might influence your decision one way or the other.
Okay, the next question is also on growth, and I'm going to direct it first to Andrew. And the question is what are some of the considerations around infrastructure investments, including people, talent, and retention of talent?
Yeah, I'm going to piggyback on what Rod kind of said at the very beginning, right? And it's to have a strategic plan. And I think when you kind of get into that growth phase and are looking and thinking about your infrastructure, people, processes, systems, that strategic plan and having a strategic plan is critically important, because otherwise you end up with what Rod was saying in terms of your infrastructure. It's a mess, right? You've got disparate, all kinds of different systems, et cetera. So really starting with that, and that goes back to, what was your overall strategy at the beginning? Do you want to be, do you want to be an operator, or do you want to be an aggregator? Both work. Some really, some behavioral health care companies have done have been able to grow and scale to a really large size, being more of an aggregator than maybe trying to be a centralized operator from that. So that's one key strategy. And then, what is your timeline on your exit strategy? How long you're going to be there? What size and scale do you want to be when you exit? Also considering, who you're likely exiting to. Is that going to be, is it going to be a strategic or another sponsor? Those all would come into kind of the considerations as you start to think about how you want to set up your infrastructure. Do you want a centralized kind of command and control, or do you want a more decentralized model from it? The one thing that I can say from experience in multiple companies is investing in that infrastructure. The sooner you can execute that, the better off you'll be, in terms of systems and people and processes to really grow and scale. But it's a balance with, kind of your cost of capital, getting to break even, having that corporate overhead. But again, going into it with a clear plan of what you're wanting to build and when you get there, I think is critically important. As you think about systems, right, you want as few systems as possible, and you want those to be the same across your platform as much as possible from that, just for efficiencies, et cetera. So things like your EMR system, your billing, and your scheduling, you want to look for a system that maybe houses all of those together, realizing that no one aspect of those three things are going to be perfect in any one system. The same thing when you look at, GL, accounting, payroll, HRS. As many of those as can be integrated together, the better off you'll be, and to grow and scale. And, I just can't say enough about the importance, in my opinion, of having your EMR and your billing system integrated. Because in my experience, you'll spend all of your time trying to make those systems talk, and never very well at the end of the day. So if you can integrate those early, I think you'll be far better off than if you do that later. I've been part of very large healthcare systems that have, built their own in the early stages of some type of system, only to get to massive scale, billions of dollars of revenue, then to look to change that system, and it's a 3-year project and millions of dollars, to convert it, because at the time they developed it because, there was no perfect system, but the cost to implement that and then maintain it is, extensive. And so I know from firsthand experience, there's a tendency at times to want to build your own system because there is no perfect system, but, I think you really would want to pause and think about the long-term ramifications over that, and what it's going to truly cost to do that. And then in terms of people, one of the hardest things in kind of that growth phase, startup to growth phase, is finding the right talent, right? Because you're looking for a management team that is roll up your sleeves, get into the details, but at the same time can operate, at a strategic level. And that's really hard to find. And what you'll find as you go through the growth, some will stay at that detailed level and are good at strategic. Some are really good at strategic. And I think it's just a, constant reminder to reevaluate your management team, not meaning that they're not good, but some will gravitate again towards the more strategic thought and grow with it, and some, will stay in the more detailed part. But again, just to kind of reiterate back to the beginning, I think a strategic plan and know where you're going as you do it. Otherwise, you're going to end up with, all kinds of different systems, processes, and probably redoing a lot of your infrastructure work down the road.
Just to add to what Andrew is saying, sometimes when companies are fast growing, they can outgrow some of the staff, just outgrow people's ability to manage as that job gets bigger, more far-flung and complex. And you got to be, if you're CEO or founder, you got to be on the lookout for that, because in a small company that's aspiring to double its size or triple its size in a short period of time, people are the key to make that happen. That's where the magic is. The same thing is true about some of the costs that you're trying to manage while you're getting the company to profitability, first to break even and then to solid profitability. I know in our own case, I've kind of been forced just by pressure from the investor sources to not buy every software product that I would like to have on day one. We spend a ton of money on data security, which is so critical in healthcare. And I've generally had a budget of several $1 million a year on some of these software products and services from vendors, and so we kind of spin that out of profits as opposed to just front end loading that and trying to grow into it. And so, as Andrew's talking about, you get the absolute things first that you need to run the business, like the EHR systems and so forth, and then add these other things out of profits as you're going forward. It just helps keep the costs and the revenues in line with each other.
The other thing I would just add to the buy versus build and to your comments around the capital allocation and sort of cost. Really depending on what stage of your business, but ultimately, if you're looking to exit to private equity, they're gonna want to see historical de novo growth execution, because they're going to want to continue that organic growth to comp down the multiple that they paid. Private equity firms are very good at acquisitions, so they can sort of help you grow from an acquisitive perspective. But if you haven't grown really organically, they might view the transaction as like, okay, so the platform that we're buying doesn't really have any historical organic de novo growth. So I think, depending on what level of exit you're looking at, being honest and understanding that you need to really prove out a business strategy that has matured and ultimately, grown in a really solid way and foundation.
Yeah, I will add to that. I've served companies 35 years at Ernst & Young, taken many companies public, a lot of secondary offerings, a lot of startups, and I will tell you the most successful companies have been ones that have the better incentive plans for their employees. You want them driving home at night thinking about what they're going to do to make sure that tomorrow is a good revenue day. With that, I'm going to move to exit, and I'm going to direct this question to Eli. And the question is, what are the key factors to consider as you enter the exit phase, including seeking strategic versus financial buyers, and then most importantly, during that process, How do you avoid a distracted management team?
If I had the answer to avoiding a distracted management team, I would be a genius. That's a very difficult question, but I guess I'll start with the first part of the question. I think it's really being honest with yourself and honest with your objective, right? So do you want to stay on with the business? Do you want to roll over and partner with your institutional partner and sort of play the upside and get a second bite to the apple? Are you a platform? Are you really a platform, or are you like a tuck-in acquisition? So really understanding what your business is and being honest with what your business is. I've been on a few sides of, both sides of the table in terms of, buying acquisitions and dealing with sellers that have thought their businesses have an infrastructure of such and such, and they can be a platform, but really missing every core dynamic that you had mentioned, Andrew, in terms of people, processes, and software applications to really support the growth of a business. And then if your objective really is to really stay on and operate the company, right? So you're probably looking more at a platform acquisition by a private equity fund. If you're looking to exit, you pretty much 100%, you're sort of done with this business, then a strategic buyer is probably the right direction to go, because they'll be more comfortable buying out your business at 100%. In terms of distracted management teams, that is, it's a phenomenon I think that operators have to deal with no matter what. Going through a process and selling a business is a full-time job, 100%. But what I've learned is really defining who the core parties in your management team that are relevant to the process, right? So I would say in my experience, in many cases that we've had, 80% of the process can be handled pretty much by the CEO and probably the CFO. I also would argue that even actually keeping a transaction confidential, even internally within your own management team, is probably a good strategy, because people get nervous, they don't know what's going to happen, what's going to be, and they might sort of leave or find other opportunities. And then, as necessary, engage individuals. I think also finding the right advisors, right bankers that know and understand your industry specifically. There are bankers out there who will tell you, they understand your industry, but really understanding like, hey, who has a track record in your space, who's done decent transactions with value, understands the buyer universe, that is looking for these types of assets. And I would interview multiple advisors, right? An advisor can really change the game on a successful process and a failed process. And interviewing buyers, having them give you a range of where they believe the asset will trade at, like a high and a low. And also, giving you solid comps that are not just general behavioral health comps, but actually industry specific. In our case, it was like, what autism assets have traded, at this level or that level that you're giving me the range at. And a good, solid advisory team, good advisors, good bankers around the table can help you a lot of that heavy lifting through, coming to a conclusion of a successful process.
And I would add, involving those advisors very, very early. Extremely early. The earlier the better, in my opinion, because there may be things they guide you on in terms of your business infrastructure that would be very meaningful in an exit, multiple at the end of the day. There may be a certain, something they're seeing in the marketplace that, you're running the business day to day that you just haven't had an opportunity to step back. So I've seen that work out very successfully, where they're talking year, 18 months out. In some cases, they've been talking for 2 years, and they did make some tweaks to the business, and it really maximized value upon the exit.
I've had occasion several times with friends of mine that started competing companies, people that used to work for me and left and started their own thing and got it up to a level where to really maximize the sale and maximize the value, it requires an investment banker as part of your advisor team. Investment bankers, this will sound like a commercial for those guys, but they can sometimes tell your story better than you can yourself. and they know how to market businesses. They know how to compare your business to other businesses that have traded, and as Eli's talking about, really come to the maximum multiple that can be applied in the situation. And the earlier, as Andrew said, the earlier you start indoctrinating those guys, telling them your story, because they won't know your story until you tell them. They'll turn around and craft the story that's going to the public, and those highlights that you want to hit to really cause somebody to see the value. Everybody, gets a copy of the SIM, and people read it, but it doesn't necessarily, they're not all going to pick up the same highlights that the investment banker wants to get across. So it takes a really dedicated storytelling, meetings with management, all the things that go on in a process to adequately get that story told and to get the fair value for the business. So highly recommend that. I would never try to do it myself.
There's an added benefit of having a banker and having been in this position before, and that is really being an intermediary between parties that are trying to come to a transaction conclusion. And oftentimes, things like the process will end up being longer than what was anticipated, and during that time, performance may suffer as a result of management team being distracted, or diligence uncovers certain things that weren't present before. The banker has the ability to advise the seller and make sure that they have all of their ducks in a row from a data standpoint and know what the buyers are going to be looking for. But there will be a time, for instance, if the performance does suffer, that the buyer is going to want to retrade the deal. And having an intermediary to kind of act as a buffer between the buyer and seller can be the difference between having a deal done versus a deal blown up. And so I've had circumstances where we didn't have an intermediary and the deal didn't come to conclusion, and in retrospect felt like if there was someone in between that acted as kind of a translator and let the different parties blow off steam, that we would have gotten something done that would have ultimately been advantageous for both parties.
The one thing I'd add to that, actually, in our experience, we've had, keeping, to the retrade point, a good solid banker won't go into exclusivity for a long period of time with one unique buyer. And there'll always be a cover bid or a cover organization that really would hold that exclusivity period or that buyer, even though he might want to retrade, because there's somebody literally right out of exclusivity that will actually take the deal, at it might be a smaller, lower price, but it won't be at the level of retrade that buyer would be. So I've been in processes, both on both sides of banker run processes and then not banker run. I think even for parties, even if you're buying a business, having an investment banker that's representing the seller is actually good for the buyer as well, really, in many different ways. It holds just ridiculous expectations for buyers that they might have, and they have to manage their client as well, which is ultimately good for the process to a successful transaction. So,
okay, caveat to that is when the banker sets a very unrealistic expectation for the seller. Oh, you're going to get a 15 times multiple, and we're going to have 20 buyers lined up. And they do that to get the bid, to get the job. And then when the process goes into full on, okay, here's where the values come back, then they have to have a very humbling conversation with the seller and say, sorry, I know we talked about a 15x multiple, but it's probably going to be closer to 12. Meanwhile, the seller's already spent that money, right? They've already picked out the boat, some cases the private jet, and then they're realizing that they're not going to get that, and they're going to be furious at the banker. So, like pricing a house where you're pricing it at a place where you're going to get bids above the expectation that's set for the seller, that's the environment that ideally you want to be in with your banker, which is giving you really good advice, backed with data and comps for the market, and setting that expectation and ultimately delivering above the expectations that were provided to secure the mandate.
Okay, very good. So we're coming down to the end of our time, and I do have a question that I would like each of the panelists to do a quick response on. And I'm going to start with Rod. And the question is, do you think in an era of consolidation, there is room for a small operator to thrive and be successful? And before Rod answers the question, I just want to point out that guy is also the founder of Acadia Healthcare.
I love that question because it's really how I've tried to live my life. I've always told marketing people, I love starting companies from scratch, and I love it when they're small. I love it when, we have a David and Goliath situation. I love to compete against Acadia and UHS and many other people in the behavioral business. And we did the same thing in the LTAC business at a point in time. And what I've found is if you have the very best clinical program in a geographic area, and you demonstrate that day in and day out, and you have a culture to go with it. And I failed to mention culture in one of the things to think about when you're first starting a company along with your strategy. I think it's important to set the culture when you first plan a company and start hiring the first individuals. Because the day you hire an individual who doesn't fit the culture you want for the company, you've made a critical mistake. They will be a cancer in your side, a thorn in your side, until the day you get rid of them. So setting culture is very important. And culture is one of those broad words that means everything and means nothing. To me, I describe it to our staff as it means who are we, what are we trying to do, what are our goals, what are our values, how do we treat each other, and how do we treat our staff to enable them to go treat the patients the way we want to be treated. And you can attach all kind of words to it like integrity, transparency, excellence, all those things which we do in creating our values and our goals. You can talk about caring about quality care, wanting to get the very best patient outcomes, wanting to make a difference in people's lives, things that inspire people with a different paradigm of what success looks like. And so culture is critically important, and I'm sorry that I didn't give that the importance it needed in the initial discussion. But I've made a practice of outcompeting my big competitors. In the LTAC business, it was Kindred and Select Medical. I love to go head-to-head with those guys. And I'm not casting any stones at anybody. Everybody has problems. Everybody has great days when things go well. Everybody gets good outcomes. But it's being persistent and consistent about that in a targeted way that lets your staff know that's who we are. This is how we behave day in and day out. I went into a community, Akron, Ohio, one time, and I was invited by the owners of this for-profit hospital system to come in and fill their space. And we were on the edge of Akron, the southern edge of Akron. And we were competing with two major tertiary care hospitals, hundreds of beds in downtown Akron. And I told our marketing staff, they're going to kill us unless we have the absolute best clinical program in this community. And we show that to the referral sources, and to the doctors and to everybody that will listen to us that we're the place you go when you are sick, about to die, and you really, really, really want to get well. You come to us. And I said, the day we sell that message to the community, we'll beat those guys every day. So you go into those hospitals and you tell those doctors and those nurses, the next time you refer a patient to one of our competitors and they reject them, we'll take them. And I said, they're going to give you the worst train wrecks they've got, but we're going to take them and show them what we can do. And suddenly that referral system that channel is going to flow. And that's exactly how it happens. And so competition is a word that I love because it takes chance out of the way. It takes fate out of the way. It puts my performance back in my hands where it belongs. And if I do it, I will suddenly become the provider of choice in a community. So there will always be a place, no matter how small, for that provider who decides to be excellent consistently.
It's a tough act to follow. I would say also, just to add on quickly, there is so much unmet demand all across all sectors of behavioral. That certainly creates opportunity for the smaller provider. As long as there's unmet need, there's going to be need for new startups, more de novo, and growth of smaller operators.
I think that's the end of our time. I don't know if there are any questions from the audience. No math questions, please. Okay, well, thank you.
Thank you.